U.S. industrial market continued to improve at a steady clip during the second quarter of 2014. Demand for industrial space remained healthy across the country, with the U.S. logging its 17th consecutive quarter of positive net absorption. Similarly, the national availability rate fell for the 15th consecutive quarter, falling below 11% for the first time since the second quarter of '08. The national average asking lease rate was essentially unchanged quarter over quarter, although it was up about 3% year over year, and approximately 27 million square feet of new supply was added to the market during the quarter. This is in line with that 24 to 30 million square feet pace that we've been seeing for the past 2 years, but it's well below the 40 to 60 million square foot pace that we saw between 2005 and 2008. Demand for industrial space remained strong during the second quarter, with more than 60% of the markets tracked by CBRE logging a quarter-over-quarter decline in the availability rate. Reflecting the broadening nature of the economic recovery, secondary markets were the best performers during the quarter, with the largest drop in availability coming in San Antonio, Kansas City, and Tampa. Most major markets continue to perform well, with the three largest industrial markets being Chicago, Los Angeles, and Dallas-Fort Worth, seeing strong demand from third-party logistics and e-commerce firms during the quarter, particularly for that newer Class A space. Overall, we anticipate that the U.S. industrial market will continue its steady pace of improvement through the latter part of 2014. We expect the levels of new supply added to the market will pick up in the second half of the year, although it will still remain well below the pre-recession levels. While these new properties will provide some additional options for tenants, overall, we expect the growing supply and demand imbalance, especially for Class A space in major distribution hubs, that imbalance will continue, pushing the availability rate down and rents higher in most major markets. On the capital markets front, the steady improvement in leasing fundamentals will continue to attract new types of investors seeking the relative safety of the U.S. commercial real estate market. As such, the industrial investment sales market will remain very active, even if interest rates begin their much anticipated climb. Overall, many of the key U.S. industrial economic indicators are headed in the right direction following a disruptive winter. U.S. trade continued to pick up during the first 5 months of 2014, with exports up almost 2% and imports up nearly 5% through May. Trade is one of the best indicators of demand for industrial space, as most of the goods are stored in warehouses before they're delivered into the marketplace. Industrial production, which measures the output of manufacturers, utilities, and mines, has also been in the upswing, growing in 4 of the last 5 months. Inventories and sales are growing as well, following a slowdown during the winter, an indicator of the growing confidence in the U.S. economic recovery among business owners. Over the past few quarters, the recovery of the Atlanta industrial market has kicked into high gear. To date, Atlanta has absorbed 7.6 million square feet of industrial space. By comparison, Atlanta saw 10 million square feet of positive net absorption in all of 2013. Moreover, Atlanta's availability rate dropped a full percentage point to 13.6% during the second quarter. At this same point last year, that rate was 320 basis points higher at 16.8%. This is by far and away our strongest improvement among the major U.S. industrial markets. A major increase in the number of deals for big box space and the notable resurgence in manufacturing are largely responsible for this market's strong performance. Most notably, however, is the dramatic increase in development activity. 9 months ago, about 850,000 square feet of industrial space was under construction, most of which was build-to-suit. Now, heading into the second half of the year, 4.6 million square feet is under construction, with another 2.7 million square feet expected to break ground in the third quarter. The lion's share of that is all spec.